Hello, everybody. Good morning or good afternoon, depending on where you are joining us from. We'd like to welcome you to Fasken's ongoing mining webinar series. Today's topic, for which we have three very well-versed experts, will be mining, climate change, and corporate net zero commitments. I will introduce our speakers shortly, but just wanted to offer one or two housekeeping matters, some of which I believe many of you will be familiar with from having attended previous sessions. We will be having a presentation of approximately 45 minutes to an hour long. Any Q&A and any questions you may have, we would like to save till the end, until we have finished our run through of the presentations. We're going to structure today's session as an interactive panel discussion. A little more difficult to do over Zoom, but nevertheless, we're going to give it a whirl. We'll have three different areas that we'll be discussing, and each of our panel members will have a comment or two in relation to each of those areas. I'd like to briefly introduce our speakers in the order that they will be speaking. We have included in the package of material bios for each of our speakers. So I'll give you a quick introduction. I myself, before I forget, my name is Tanneke Heersche. I'm a partner in the Global Mining Group at Fasken, and I will simply be moderating today's session. Leading off the substance will be Emilie Bundock, and Emilie is a partner in our Montreal office, and she's an active practitioner in the Global Energy Group with an emphasis on environmental matters. Emilie is going to be followed by Kai Alderson, a partner in our Vancouver office, also a very active member in the Global Energy Group and a member of the firm's ESG steering committee. Following Kai's comments, we're going to have Lisa DeMarco. Lisa is a senior partner and CEO of Resilient LLP, which, as many of you hopefully know, is a climate-focused boutique law firm. And Lisa will be adding her remarks to Emilie's and Kai's. I think it's a bit trite to say, but I'll say it anyway, that not a day goes by without a headline on net zero commitments, and whether that is net zero commitments made within or by companies active in the resource industry, or whether it's financial institutions, the fashion industry, agriculture. It is very much on everyone's mind, and is probably going to be increasingly so in the coming years, and very much so in the coming weeks with COP26 around the corner in Glasgow in November. The mining industry itself has been very active, and I'm sure many of you will have seen last week's announcements by the ICMM with some of the world's major mining groups committing and making net zero commitments by 2050. We also have this week the MLE week, of course, in London. And there's been some announcements of mining firms using LME Passport to disclose some of their CO2 emissions. So there are frequent engagements across the market and across the industry. We thought what we would try and do today, given the scope of the field, is to start off with a bit of a lexicon and a little bit of a what does it all mean? We will then move to a session on the implications for the mining industry of making net zero commitments and some of the risks mining companies face in doing so, before finishing off with a short session on trends and what trends the mining industry should look to in the voluntary carbon offset and global climate policy areas. I think all in, it will be a very interesting session, a very current session, and I hope you enjoy what we have to offer. With that, I will hand it over to Emilie for our first session. Emilie?
Thank you, Tanneke. Hi, everyone. So we'll start with a little 101 or lexicon around net zero commitments. So we have a few slides to set the stage for this discussion and make sure we're all on the same page. So Nick, you can move to the Paris Agreements slide. So there are multiple drivers that are currently pushing mining companies to commit to achieving net zero emissions in the next few years. In the background of those commitments, there is the Paris Agreement. So just a reminder that the Paris Agreement is a legally binding international treaty on climate change. It was adopted in 2015 by 196 parties at COP21 in Paris, and it entered into force officially on November 4th, 2016. The goal of the Paris Agreement is to limit global warming to well below 2 degrees Celsius, preferably 1.5 degrees Celsius compared to pre-industrial levels. We can switch to the next slide. So what difference would it make to limit global warming to 1.5 degrees versus 2 degrees? Because we sometimes hear both targets. Basically, scientists from the Intergovernmental Panel on Climate Change suggest that a number of climate change impacts could be avoided by limiting global warming to 1.5 degrees compared to 2 degrees. So you can think about the global sea level rise or the frequency of an Arctic Ocean free of sea ice in summer, the impacts that would have on our economy, and as well as impacts on nature, such as coral reefs, for example. As science also shows that adaptation for us would be fairly less painful in scenarios limiting global warming to 1.5 degrees compared to 2 degrees. Now, why? So if we move to the next slide, 1.5 versus 2. So why 2050? So why 2050? In short, it is to meet the Paris Agreement's temperature goals. So to keep a rise in global temperatures to 1.5 degrees above pre-industrial levels. Next slide shows you a graph showing you why it's important and I would say the magnitude of what needs to be done to get there. We can move to the next slide now. So what is driving companies to adopt net zero commitments now? Basically, as science shows, policy, technology, and behavior need to shift across the board and rapidly. So the reality is that a country will not be able to meet a net zero commitment without transforming its economy and industry. So with regulation usually evolving hand in hand with investor pressure, businesses are increasingly coming forward with net zero commitments. Others who are not doing so or not doing so yet should assume that they will be required to do so in one form of it or another, as governments will move to deliver on their commitments under the Paris Agreement, and as shareholders and customers will also increase their demands for action in the climate change space. So to a certain extent, peer pressure is driving mining companies to adopt net zero commitments. And one example that was mentioned by Tanneke is last week, the International Council on Mining and Metals announced that its 28 members have committed to a goal of net zero scope 1 and scope 2 greenhouse gas emissions by 2050 or sooner, in line with the Paris Agreement. So we'll get into what's the difference between scope 1, 2, and 3 emissions. So these categories are shown on the slide, and they come from the GHG protocol, which is a protocol to assess greenhouse gas emissions. So scope 1 and 2 emissions are basically carbon generated directly by miners when they extract ore from the ground, as well as emissions generated on site to process the metals that are extracted. Scope 3 emissions are not comprised in the ICMM commitment for now. So those scope 3 emissions are those generated by the end customers. So you can think of refineries that process the materials, such as iron ore or nickel, for example. It's generally more difficult for companies to control scope 3 emissions, but still the ICMM in its announcement last week said that the group intends to set scope 3 emissions targets by the end of 2023. And we'll see later on in the presentation how you can develop strategies to reduce those emissions or make those commitments towards scope 3 emissions. Now, what is net zero? We can move to the next slides. So net zero, just the expression, usually raises a lot of controversies, a lot of different positions, but basically net zero emissions are achieved when anthropogenic emissions, so emissions by human activities of greenhouse gases to the atmosphere, are balanced by anthropogenic removals from the atmosphere over a specified period. So technically speaking, net zero means you either do not emit greenhouse gases or you offset your emissions by removing a corresponding amount of greenhouse gases from the atmosphere. It gets more nuanced than this, and this first, I would say, panel discussion is going to discuss a bit around, for instance, what it means to be carbon neutral versus climate neutral and other such expressions that we can hear in those discussions. So basically, carbon neutral, carbon refers to carbon dioxide, not all greenhouse gas emissions, but it goes more, I would say, broader than that in the discussions. And then I'll turn it over to Lisa now that we've seen a bit of the context and background. And I know Lisa has a lot to add to this conversation.
Thank you so much, Emilie. Certainly, this is the big conversation right now, and much of the controversy from a customer and consumer perspective. The distinction between claims of companies as to whether or not they're net zero, carbon neutral, or climate neutral is causing some customer confusion. And that has a number of entities, including antitrust and competition bodies, very concerned about things like ensuring claims aren't being made that are false, claims are not being made in a manner that is fraudulent, that affects competitive positions between the competitors in a sector or marketplace, and really allows for openness and transparency. So these are very significant impetuses in the broader market, and we're seeing standards starting to come to play to follow suit as to where and how we do use these terms and what is required when we use those terms. So I think it's a great point, Emilie, that we really point this out for any of those folks on the call that are looking at the associated target setting and the Task Force for Climate-Related Financial Disclosures reporting and the metrics they want to set. They should consider very carefully what language they use and what is most conducive to openness, transparency, and clear communications with, in particular, customers that are most vulnerable. Thanks very much. Shall I pass on to Kai?
Yeah, thanks. Thanks, Lisa. That's a really useful summary there, and thanks, Emilie, for the overview. I would agree that this is of all of these, the just educating yourselves around what does net zero mean to the audience is very, very important. That a lot of issues that we see is where people may be using terms interchangeably, not even realizing that there is a difference between this different terminology. Net zero has a very, very particular concept around not only aggregate balancing by 2050, but setting discrete goals in timeframes earlier than 2050, prioritizing internal reductions of emissions before residual emissions are offset with carbon offsets, and then prioritizing carbon removals over carbon offsets that are avoidance-based. We'll be talking about some of those terms later, but it's just really important to understand that these have concrete content in the concepts, and also that they're hotly contested. And so we're seeing lots of civil society groups and activist groups trying to ratchet up the definition of net zero in a kind of a quest for ever higher floors, and that can be very challenging for companies. So you have to keep your eye on what is the terminology and how that may change in the future. Part of why I think it's such a good thing that the ICMM has come out collectively to advance a net zero position, because that's an organization that can actually articulate a vision of net zero that can provide a point around which companies can cohere and have a legitimate stand, even as others are saying, well, net zero means something else entirely. So keep an eye on that. That's an area that we're going to see some evolution in, and it's well worth keeping abreast of the current debates on net zero definitions. I think that's back to you, Tanneke.
Yeah, no, thanks, Kai. And actually, as I'm listening and trying to sort of evaluate as on the receiving end, within a specific industry like the resource industry, it's certainly becoming very clear that standards being developed, industry-informed positions being taken through organizations like ICMM will be very helpful, I think, to groups as they try and define not only what a net zero commitment means for them, but how they're going to achieve it, because the implementation and how to get there also very different for different industries. I think, Kai, I'd like for you to actually continue on the kind of part of the thread you were on, and so as a resource group or as a resource company, having made net zero commitments, what are now some of the risks that I need to be aware of, and how to kind of evaluate those risks? We've touched a little bit on some of them, whether it's antitrust, whether it's disclosures, but I think it would be useful if you could lead us through some of the key sort of risk parameters that companies should be aware of once they've adopted a net zero commitment.
Sure, and thanks a lot, Tanneke, for the introduction, and thank you all for attending this session. I think this is going to be an increasingly important area as we navigate the next few years. So a few points I just want to make by way of framing to set up the discussion. Partially this is blindingly obvious, but it's just important to put right up front. For now, companies are not required to adopt net zero goals as a legal obligation. This is by and large a voluntary commitment that companies are making in response to the peer pressure and ESG investors and the other dynamics that Emilie talked about earlier. And so, we're seeing some inklings of net zero obligations, particularly in respect in Canada of project approvals under the Impact Assessment Act federally. If you are developing a mining project in Canada that will run past 2050, as part of that process, you'll be required to provide a net zero plan. And GHG emissions and other issues are increasingly playing a role in project approvals, both federally and provincially. So it's definitely true that we're heading in a direction, particularly in the mining industry, where there may be some concrete obligations. But generally, when we're talking about net zero commitments and we're talking about risks, we're talking about indirect risks. We're talking about legal consequences of a decision that's made for business reasons. And so those risks, because it is a business decision, have to be construed or considered in your particular context. None of these are saying that they're, nothing that I'm about to say should be thought as somehow determining that the risks are too great, or that the better course is simply to not talk about climate change. That's not at all the message, even though we'll be talking about some risks. So the first thing I think is a business risk around adopting a net zero commitment is not so much the act of adopting it, but perhaps adopting a net zero commitment, not understanding what it entails, and then not implementing it and being transparent in a way that satisfies the expectations of ESG investors or regulators or non-governmental organizations. And so I'm sort of labeling all of this under the bucket of greenwashing allegations, but I think it's really important to unpack that term because greenwashing gets thrown around as a term of criticism quite a bit. And I think it means many different things to many different people. So sometimes greenwashing is used just to criticize incrementalism. Companies aren't acting now in the way that they need to be if by 2050 they'll be at net zero. I've even seen reports published very recently saying, well, if you look to corporate behavior from 2010 on for over the last 10 years, then they're not on track to achieve Paris climate targets, and therefore net zero is greenwashing. Well, clearly that's not a good argument because the entire idea behind net zero by 2050 is setting incremental goals, gradually developing policies, and bringing direct emissions down over time as solutions and technological solutions become available. And if you're using this stringent net zero definition, only offsetting for residual emissions that you can't reduce internally. So incrementalism itself, that's not a fair cop. That's just part and parcel of what net zero by 2050 means. I also think greenwashing tends to be used to just criticize policy choices, such as the use of offsets. We'll talk more about that later. And you even see that, frankly, and we're amongst friends, so I can say it, but you even see it as sort of a just generally criticizing private enterprise as not taking care of the planet. And so anything that companies are doing will be accused of being greenwashing. And so there are some versions of greenwashing that you, I think, as a company don't need to, I mean, these are communications challenges, obviously, but they're not a legal risk. I will say, having sort of dismissed some parts of greenwashing, I fully believe that these will be a continuing reputational issue for companies is just part and parcel of the rhetoric that is emerging in the climate sphere from a policy perspective. Very recently, there was a well-publicized letter from NGOs criticizing Mark Carney and the activities that he's been undertaking in terms of financial market and financial actors committing to net zero in the run-up to COP. And he's been criticized for greenwashing. And many of the NGOs behind that letter who were primary signatories are well-known Canadian NGOs in the environmental space. So for Canadian mining companies and mining companies operating in Canada, this is just going to be part of what we have to deal with. And so understanding net zero, understanding and being able to communicate effectively in a way that's non-dismissive, but addresses what companies positively and affirmatively are doing in the area of GHG reductions is very, very important. So switching from the kind of nebulous reputational issues to the real legal risks, if I can put it that way, and how to avoid a risk. You know, I think the core of the greenwashing claim is used to attack companies or criticize companies where there is a gap between words and action. And so the answer is to make sure that gap is as minimal as possible and to explain what is being done in a very practical way to achieve net zero commitments. Net zero by 2050 is an intrinsically difficult goal to communicate because you've got a very long-term, very speculative goal, and so there is a great deal of temptation to just backload the action later. Having incremental steps, having a plan, having objectives in the meantime that will take you towards that 2050 goal is very important, I think, not only for enculturating within the company the pathway to transitioning to a carbon-constrained economic environment, but also very important, it gives you something to communicate and to show that you are reporting out on specific actions taken with the long-term goal in mind. And always remember that net zero is actually a policy with content. It's not marketing puff. This is something that's very important. Consider how your claims are going to be perceived and always be able to back up your claims with either evidence or at least a basis for the claims that you're making in the net zero sphere. I think Lisa was right to mention earlier that, you know, this is actually going to be part of the kind of competitive environment that securities disclosure regimes and competition law were designed to achieve. If you think about how reserves are reported and many things, we can expect regulatory pressure to ramp up over time. But for now, I think the important thing for companies to think about is we can avoid some of that pressure on the regulatory side by taking net zero claims seriously, measuring and managing steps and reporting out in a responsible way on the steps that have been taken. I'm going to move quickly on public disclosure issues. I think there are a lot of concern over public disclosures, particularly in a securities law context. While this can be an issue, I think that what's needed is a calibrated approach, not an approach that says, well, we must stay silent about this. I think making sure that, as I said before, you're reporting on things that are tangible and that can be reported very concretely is critical. Be aware of the particular disclosure regimes that you're under. And I would say that one of the issues that I'm seeing, which may be counterintuitive, especially to securities lawyers, is it's important to not overqualify what you're doing. Activists can read securities disclosures just as investors can. And sometimes I've seen overqualified language, which to me just reads like typical securities lawyer qualifications being used by NGOs to go to regulators saying, well, look, the company isn't actually confident that the solutions it's proposed will achieve its goals that it's telling you it can achieve. So I think it's important to be calibrated in your disclosures and to think about how disclosures in one area can be used or will play in another regulatory arena as you're developing them. Don't overclaim, but also don't undersell. ESG rating agencies are staffed by humans. Mining companies are investing a great deal of resources in their net zero initiatives. And so you need to tell your stories effectively in order to make sure that you're getting a reputational return for that investment, as well as the business learning that you need to cope with an increasingly carbon constrained world in the future. So very important to not take maybe the easy option of just remaining quiet. I think one thing I'll just say to close out is around litigation risk. So and I think this was mentioned earlier, but in Australia, in the US and elsewhere, greenwashing claims in the area of climate have been the subject matter of litigation and are being actively litigated. There has been some activity in Canada in relation to securities disclosures, but this is an area that is growing internationally, and we need to be prepared for in Canada. To date, we have not seen in Canada private actions against corporate defendants for damages related to climate change. There are some obstacles to that in Canada. Most importantly, if someone were to assert a novel tort claim against a corporate defendant, there would be an important analysis that the court would have to do in terms of how much reliance did the plaintiff really put on the claims of the corporate defendant as part of the proximity analysis in establishing a novel tort claim. So I think it is really important, and is perhaps an under-lawyered aspect of corporate disclosures, where there is right now, we're right on this cusp of so far it's been marketing and CSR groups and public relations considerations to some extent have been driving net zero commitments and the way those are articulated. But we're entering a world in which the way that net zero claims and progress are communicated may actually give rise to legal risk in the future. And so that's an area where I think General Counsel should pay more attention in terms of making sure that net zero commitments are communicated in a way that doesn't induce reliance or overpromise to potential plaintiffs. So I'll wrap up there, and I don't know if anything that I've said sparks comments from you, Emilie.
Sure. I think I'll just add a bit to what you said around litigation and trends that we've seen in the past few years. So I think we can say that it will continue to grow. So as you mentioned, it's not that huge right now, but I think it will continue to grow because we see, people feeling the urgency of having actions taken around climate change. And I think there are some common themes that are shaping up in climate change litigation. One of those is, of course, communicating your goals too positively so that it amounts to greenwashing is certainly a risk. But also we're seeing plaintiffs filing consumer and investor fraud claims around failure to properly disclose climate change risk. So climate risk information is either not disclosed or disclosed in a misleading manner. And that goes around all the work or the actions that will have to be taken around adaptation to climate change, because we've talked a lot over the past years about fighting climate change, reducing emissions, but we are entering a world where we need to adapt to climate change, and that's something that businesses will need to disclose in terms of risks and costs, sometimes moving facilities to other locations. Another series of cases or trend in litigation will probably be around pre and post disasters. And I think mining industry can certainly have, you know, some assessment to make around potential disasters that could be caused by climate change. And again, this goes to adaptation. So cases around the company's failure to properly plan or manage the consequences of those extreme climate events. It's starting in other jurisdictions, less in Canada, but I think we can certainly expect that it will grow. Doesn't mean that they will succeed with those cases, but as everyone knows, it's not super fun to be part of a litigation that can drag on for many years. So there are costs associated with that. So we usually prefer to avoid it. And I think we'll see more litigation coming against financial market actors for failure to disclose. Because that's an area where we're seeing a lot of activism around climate change disclosure. So usually we'll see that in litigation cases. I'll turn to Lisa to see if you have anything to add on this.
Thanks very much, both Kai and Emilie. I think you've done a great job at discussing the risks. I might just add a few points in around mitigating some of those risks. And in particular, I think Kai has spoken really carefully about the appropriate white fence that we walk on when we're making disclosures. And the two sides of the fence are, first, underselling what you're doing, and the second is speaking too confidently and without humility. And there is an art to how we say what we say, not just what we say, when it comes to climate disclosures. So that's something to think about very carefully. And the ongoing process of updating and learning and accountability for targets that are met is very important. And one of the ways to mitigate the risks around what you're saying is to look at what are your competitors and cohorts doing, and really chart areas where there is a need for improvement, and or there are areas where you're doing very well. And I think that's very useful to bring to bear. Here's what we're doing. Here's how we stand within our sector writ large. And here's where we really need to make progress. And here's where we're ahead of the crowd. And in that regard, my last point is in relation to the importance of data. Climate-related data, domestically, North America-wide, and globally, is now becoming increasingly important in relation to both actions on what you're doing, foreseeability of what should be done, and that's an important term in the legal world. It pertains to negligence, so foreseeability of what should be done, and how you do it. If you're far outstep with your comparators and cohorts, and the data shows that you are way out of line with what should be done, or conversely, way ahead of your comparators and cohorts, it's very important and very helpful. So there are a number of sources of climate data that you may want to look into to assist you in mitigating the risks that both Kai and Emilie spoke of so well, so eloquently.
Thanks to all three of you. Listening to this area, the developments, the ongoing uncertainties, I think, certainly, I speak for myself, makes me sit up and take notice. In the absence of formal regulatory structures, I think, at least your point is well taken, and so was Emilie's earlier about the ICMM, just to see what the industry as a whole is doing, how your competitors, your partners, in many instances, are tackling the issues, and what is successful, what is not successful, and where is it all going? So Lisa, to pick up on your comment of foreseeability, where is it going and how do we get there and what can we do to get there? And I know we won't be able to tackle every single element of scope 1, 2, and 3 emissions, all of the underlying data, how to evaluate performance. But I think it would be quite useful to have a short discussion on some of the trends that resource groups, mining companies should be aware of in the voluntary carbon offset and the sort of global climate policy areas related to net zero commitments, and how those are informing the going forward space around net zero. And I think, Lisa, I know you've just finished speaking, but we're going to start off with yourself on this and then followed by the two others.
Thanks very much, Tanneke. Let me start with 5 main trends. And I know my colleagues will have a number of comments that can elaborate and or expand on them. But from my perspective and vantage point, I'm seeing 5 significant trends. And the first is, of course, carbon pricing. Any number of extractives and other companies, including consumer packaged goods, agriculture, food, and beverage, are all trending towards the use of carbon pricing and or carbon markets to meet their various net zero commitments. So the first trend is carbon pricing itself. We are seeing a very significant increase in the development and implementation of mandatory, not voluntary, mandatory carbon pricing regimes around the world. So as of early 2021, we have 64 jurisdictions that had already implemented carbon pricing regimes, and we had a further 15 that had systems in development. So this is a very significant percentage of the world's major jurisdictions, and at last check, covered approximately 30% of the existing world's greenhouse gas emissions by already implemented programs. Expect that trend to increase. We expect to see a significant number of additional jurisdictions coming forward. So trend number 1, mandatory carbon pricing. Trend number 2. This is like my David Letterman countdown list. Trend number 2 is scaling voluntary carbon markets and the convergence of voluntary and mandatory carbon markets. The task force for scaling the voluntary carbon markets, which is the Mark Carney most recent task force, has the objective of increasing by 15-fold, so 1,500%, the scope and scale of existing voluntary carbon markets to really start initiating the overarching economy-wide transition to a lower carbon economy. With that in mind, we have seen a huge increase in the activity in voluntary carbon markets. That is the Voluntary Carbon Standard, the Climate Action Reserve, the American Carbon Reserve, Gold Standard in Europe, many voluntary carbon markets over the last 6 months, particularly the last 18 months. And we've seen over a 300% increase in the both activity, and then the prices have correspondingly increased quite significantly. So trend 2A is the voluntary market increase. Trend 2B is the convergence of the voluntary carbon markets and the mandatory compliance markets. And really, the Paris Agreement is responsible for that. Emilie spoke very initially to Article 6, which is the markets provision of the Paris Agreement. And the current context is, if countries are going to participate in cooperative mechanisms, carbon trading, to reach their nationally determined commitments under the Paris Agreement, there has to be a corresponding adjustment between two countries. So if one party is using a carbon credit, they record that as a minus. If one country is selling a carbon credit, they record that as a plus. And that link between the mandatory Paris markets and the nationally determined contributions and the use of voluntary instruments such as voluntary mechanisms in the airline sector, voluntary mechanisms in and around nature-based climate solutions is causing a convergence, increasingly so, among the voluntary and mandatory markets. Trend number 3, the rise of carbon removals. We used to very generally speak to offsets writ large to include both avoidance and reductions, particularly in industrial emissions, and removals, predominantly from nature-based afforestation and reforestation. Now, in particular, as a result of the European Union Fit for 55 policy document, which denigrates to a certain extent avoidance and reductions and prefers to a certain extent removals, we're seeing the marketplace really focus and enhance the value of removals, not just from nature-based sources, but also from negative emissions technologies, such as direct air capture and carbon capture and storage. We're seeing a lot of this going on and significant activity through the Oxford principles, et cetera, really focusing on and hypervaluing, really placing the value on taking CO2 out of the atmosphere to address our budget issues, CO2 budget issues. That's trend number 3. Trend number 4. Last but certainly not least, the important role of Indigenous-led offset projects, particularly in and around nature-based climate solutions. So forestry, reduced emissions from deforestation and forest degradation, associated avoided conversion of forests, and many of it involving traditional Indigenous territory. We expect to see major developments there in and around the COP negotiations, particularly through the local communities and Indigenous peoples platform. And last but not least, we expect to see enhanced growth of related vigilance, both commercial among competitors and non-governmental among NGOs and other stakeholders in and around the claims that are being made around net zero. So those are the 5 main trends I see. And with that, I'm sure Kai has many thoughts and many additions to help inform you about where we see things going. Shall I pass it over to you, Kai?
Sure, thanks. Yeah, I think the carbon, I'll just pick up on a couple of themes, Lisa, around the carbon offset markets, I think, because this is an area that is from an industry perspective, from a mining industry perspective, particularly, because the mining, there is a lot that can be done in the mining sector to directly reduce GHGs from operations. But there are going to be a lot of residual emissions from mining, particularly if you include a scope 3 emissions. And so in a net zero world, particularly as we move forward, carbon offsets are absolutely essential for mining in this world. And it's really important, I think, to think about trust in those carbon offset markets as a collective good for the industry. And that trust is extremely fragile, or even in a deficit position right now. A number of civil society organizations have been quite opposed, quite vocal in opposition to carbon offsetting because it's seen as a get out of jail free card or an indulgence or something like that, where you're allowed to pollute. And that, of course, is technically not at all what's going on. And it is true that in the early days of carbon offsetting and the voluntary markets, there was some shoddy work done, and we're sort of collectively suffering from a few people cutting corners early on. So I think it's really important to just acknowledge that carbon offsets are essential for mining companies to achieve net zero by 2050. Therefore, trust in offset markets, as I say, is a collective good. And there's kind of an industry role in that to be just as concerned about environmental integrity of carbon offsets as the NGOs are, because we're all going to need to rely on those. So that would be one point. Second point, I think, is just to support the idea of carbon removals. I'd also say, as an increasingly important component of the offsetting portfolio, I'd also, in the area of removals, there's sort of a growth in different instruments. So not just the sellable carbon offsets, that's one model on a project basis. There's all sorts of interesting innovation and experimentation happening with new instruments. And I think that's actually going to be a huge opportunity for mining companies in the area of removals, and so that's something to keep an eye on as an economic opportunity, as well as a way of achieving net zero by 2050 goals. And the final trend that I'm seeing, which is less happy, but seen it a couple of times, is there's sort of an emerging I don't know what to call it, unholy marriage maybe, between resource nationalism, which is on the upswing in some countries, and ESG criteria more generally, if you think of environmental or human rights standards, and climate in particular. And so I think there's always a tendency for resource nationalists to try to appeal to a progressive segment of the global north, if I can put it that way. That's been a historical truth for a very long time internationally, and we're seeing that now in terms of folks using the Paris Agreement as a rod to or as a leverage point somehow to try to extract more concessions from mining companies operating in other countries. And so all the more reason, this is my plug, I guess, at the end, all the more reason for mining companies to understand what is and isn't required of them and where the direction of a global climate policy is heading, stay abreast of it. Lisa offers a fantastic reporting services, and it's really important to stay abreast of these developments, and because it is going to be an increasingly part of the business context that mining companies are operating in around the world. Those would be my points.
Thanks very much. And Emilie, did you have anything to add to that?
Yeah, I think maybe I'm interested in the credibility point that Kai raised around voluntary carbon offsets, and I agree it's probably one of the legacy of the first players or the first existence of the voluntary market in particular. But if we go back to the net zero commitment and the risks around making those commitments and how you can still use offsets for, in particular, probably your scope 3 emissions, and at the same time avoid all those risks associated in making commitments, net zero commitments, and having your policies or plans that make sense and are not necessarily criticized it as being greenwashing. I think a credible corporate commitment will first begin with setting an emissions reduction target that covers your direct and indirect greenhouse gas emissions. So that will give you some credibility right from the start. And of course, even before that, if you don't have emissions baseline from which to set a target, you'll need to do that first. So that will create some sort of the foundation of your commitment. And then when you align your target, of course, with science, and your commitment should be in line with the Paris Agreement, so 1.5 degree pathway. And then once you've set that, your focus should be on real emissions. So first, primarily on real emissions, improving energy efficiency, transitioning to renewable energy, addressing value chain emissions. And then, of course, you will want to use voluntary carbon offsets probably to tackle those emissions that you cannot reduce, sometimes because of technology, sometimes because they're inherent to your industrial process. But I think that's where you can make the best use of voluntary carbon offsets in your strategy. So that's where I think we're moving in terms of adding some credibility to those net zero commitments and the plans that go with it.
Thanks very much. And Tanneke, I think we're back over to you. And just a concluding thought, I think we do all have an obligation to, as Kai would say, not have carbon instruments viewed as indulgences, or as my South American colleagues would say, indulgencias. We have to have them viewed as credible strategies, particularly when you're talking about those scope 3 emissions, as Emilie says. So that's our final thought on that point. Back to you, Tanneke.
Thanks, Lisa. And I have to admit, it's those scope 3 emissions that when I look at them, not only in the context of the mining industry, but other sectors as well, that I think we're really going to see some development and some interesting positions being taken. And I think it will be actually very difficult over the next couple of years, given how aggressive some of the targets are. And quite frankly, given current management structures, supply chains, and the processes involved in obtaining the underlying information that companies will need in order to address the scope 3 emissions issue. Anyway, I'm sure we could have actually an entire session on scope 3 emissions, but what I did want to actually just follow up on, we spoke a little bit about developments and trends, and there are quite a few of them, and they're quite wide ranging. But I'd just be interested to know from perhaps each of you what you think has been the most surprising development. And this is not necessarily a technical legal development, but just from a broad sort of market industry perspective, what has been to you the most surprising? And I ask you because you've all been actively involved in this area for many, many years. So I'm sure there will be things that have perhaps not caught you off guard, but that have sort of also made you sit up and take notice. So Kai, I'm going to punt this one at you first, and then maybe Emilie and Lisa can follow with what might be your most surprising, and hopefully, Lisa, by the time it gets to you, well, maybe it'll be the same one as Kai's, but let's see. Okay, sure. Kai?
Okay, so I'll give two related ones really quick. First is the mainstreaming of ESG in financial markets. I was involved in what was then called the socially responsible investing sector before I became a lawyer 20 years ago, and we were scrabbling for attention and for marginal investors off to the side. And just the fact that this is now front and center in financial markets is absolutely amazing and shocking to me, surprising to me as a broad trend. And the corollary of that is the breadth and scope of divestment campaigns. Even a year ago or a year and a half ago, I was thinking that mainstream divestment campaigns would be focused on coal, thermal coal, and that there wouldn't be the kind of broad success of divestment campaigns around fossil fuels more generally. But over the last 6 months, we've seen increasing moves in that direction by large international sovereign wealth funds and other investment pools of capital. And that's taken me a little bit off guard. I don't know who's next. Who shall be next? Emilie?
Emilie is going to go next.
Okay, sure. Mine is a bit different. I would say the link between the global fight against the COVID-19 pandemic and the global fight against climate change. So I think seeing those two topics being so important in the news, even having net zero commitments multiplicating over the past year and even a bit before then, I think there's a renewed global will to take action to address climate change, and then a renewed confidence that net zero is feasible. So net zero by 2050 is feasible. We've seen Larry Fink of BlackRock make that connection between the global efforts to address the COVID-19 pandemic and climate change in his 2021 letter. The focus was really on sustainability goals, climate change, financial disclosures, and those commitments for a net zero by 2050. So I think we can learn from the COVID-19 pandemic and just continue fighting or continue taking action.
Lisa?
Thanks very much. I'm going to try and slip in two if I can. The first one is the prices. Truly shocking. We did our first carbon deal in 2001 for a multilateral development bank. And the prices were, 25 to 50 cents a ton for a compliance instrument, for a mandatory carbon instrument that could be used for compliance in the broader Kyoto Protocol world. In the last year, we've seen what used to be the lowest priced form of carbon instruments and nature-based go from more than orders of magnitude higher and rapidly increasing. So the price trajectory has been a pleasant but somewhat shocking surprise for someone who's got 25 years of carbon battle scars. And the second one is theme and variations of what Kai has said. In particular, we saw very little definitive incorporation of climate risk and activity in the financial institution sector over the last 20 years. Some rumblings, but not a lot. We saw a few funds created, and green bonds were a bit of a sustainable finance trend and are still. In terms of the actual speed with which financial institutions themselves are looking at considering taking on targets, particularly net zero targets, that has shocked me in the last year. And I think the GFANZ process, the Glasgow Financial Alliance for Net Zero, has really created some impetus there. So also an interesting surprise. Back to you, Tanneke.
I think there's no shortage of surprises. And I think for myself, although coming from a slightly different perspective, I think I have found the speed with which the Say on Climate initiative has taken off quite astonishing, and the extent to which it has encompassed various sectors and numerous geographies. So I think it's further evidence of the globalization of this issue, and the speed with which markets are engaged in furthering the goals of the Paris Agreement. So So I have, at least I was just thinking about your carbon battle scars, and at the risk of adding another one, thought I could maybe ask you a carbon related question, and see if you could let us know or tell us a little bit more about border carbon adjustments, and how those might impact the mining industry. I mean, amongst other sectors.
Yeah, and this, if I had to add another trend, this would be trend number 6 in particular. We are seeing, it started with the EU very actively coming out with the climate policy that included its carbon border adjustment mechanism that really looked to add a border tax on materials that originated from jurisdictions that didn't have carbon pricing as they were imported into the EU. And there were thoughts that, this is what we would call a fluff policy. It's there, included in the package, but it will never be implemented. Not so. They have definitely moved forward quite rapidly and are in the midst of finalizing the details of the CBAM. And on the heels of that, we saw Canada announce an intent to move forward with the carbon border adjustment, and more recently, the US. So it really ties into something that Kai said around nationalism and trade nationalism, using carbon as a vehicle or a vector. We're also seeing it in terms of trade protectionism, using carbon, sometimes validly, but sometimes in other ways to facilitate border taxes and other measures that have the effect of favoring local production. And as I say, sometimes that's very valid. You don't want to put your own producers at a competitive disadvantage because they're doing the right thing and complying with the carbon pricing regime. In Canada, going up to $170 a ton by 2030. In other jurisdictions, it may be used quite selectively and applied quite selectively to certain sectors. So that's something to watch, particularly for the mining and extractive sectors, because they really are quite often emission intense and trade exposed, and they're price takers. The price for the commodity is often set on a global market. So very interesting to see how that plays out globally. So that's something I would watch very, very closely for the mining sector.
Yeah, Lisa, I might just jump in and add just a thought there, which is, I agree with you. This is a critical one, and it's kind of flying under the radar. It feels really big. It feels enormous and like something that would be very challenging to implement, but it does seem to have legs. And what I'm especially worried about from a mining sector perspective is these kind of carbon border adjustments could be implemented in ways that are beneficial to other sectors. And so you may have advocacy work going on for the forestry sector or something like that, that could then provoke a reaction that would be bad for the mining sector. So anything trade related, like just being on top of this, being engaged through industry organizations, making sure that whatever emerges is trade facilitating and not disruptive, and just being aware that these kind of border adjustments could impact different sectors differently, obviously, and industries like mining will have an interest in the largest possible, drawing that border around the largest possible number of markets within which no adjustment is needed. So that's an area I agree is absolutely essential to watch closely.
Yeah, totally agree. The devil's in the detail there. They could be very good for the mining sector to facilitate level playing field in the transition to sustainable mining. On the other hand, if they're designed improperly, they could be very, very damaging. So you really want to ensure the devil is in the detail and the design is appropriate. Sorry, Emily, over to you.
Just maybe to add on what you were just saying, I think it's true that the devil lies in details, because if they're well drafted, those provisions, they're protected under certain exceptions in trade agreements. Whereas if the policy behind it is not serious or is not well, or doesn't sit on a well-grounded foundation, they can be open or up for challenge, legal challenges. So we'll see how that plays out in the near future, I guess.
Yeah, Tanneke, as we hand back to you, we have, one active historical NAFTA dispute about carbon markets. I would expect more to occur as we see implementation of these border carbon adjustments.
No, absolutely. And I would like to just sort of move, if the panelists are okay with that, to a few questions that we have from the audience. And I will perhaps direct the first one at Lisa. Maybe you can start off. It's a fairly general question, but we've had a question about how individuals get involved in this area. And for example, how would one invest in carbon credits? So a slightly, different question than we've been talking about, but maybe you could give us and the audience some thoughts on that.
Yeah. There's that's a great question, and there are a number of answers depending on why you want to invest. If you want to invest to achieve your own net zero commitment, for example, our law firm has a net zero commitment, carbon positive commitment. We go through a few sources, B0 or Radical or NCP. There are a number of entities where we purchase predominantly removals from at this point in time, and you can do that. But if you actually want to use it as an investment vehicle, we're seeing a real increase in streaming. And companies that are looking at facilitating either funds for investment in carbon credits and or streaming opportunities. And a recent Canadian company in that realm is Carbon Streaming Corporation. And there are others in Europe and elsewhere that are really looking to activate and involve. So either directly from direct purchases, through brokers, through specific intermediaries, and or through funds and streaming opportunities would be the short answer.
Kai, Emilie, any thoughts?
Well, maybe just an easy way, if it's more a personal offsetting strategy that you're looking for, when you, for example, purchase your flight ticket, there's very often an option to calculate your emissions. And then you have various ways in which you can compensate your emissions by purchasing some voluntary instruments on the voluntary carbon offset market. So that could be an easy way, and it gives you a sense of how much it costs and how, like, the extent of your commitments and the budget that you'll need to put in there.
Great, thanks, Emilie, Lisa, for your thoughts on that. I think we have time for one more question before we wrap it up for the day. And we have been spending a fair amount of time over the past hour and a bit talking about developments that we've seen. So I have a question about perhaps some thoughts on legal developments that we may not have seen or that we are not talking about and that may be available or could be available to assist resource companies in trying to tackle this space while you continue to drive your businesses forward. Kai, you want to give this one a shot?
Sure. I spend a lot of time, as Emilie and Lisa both do as well. We're all actively engaged in carbon offset transactions and project development work for clients. And speaking from my perspective, I think there is if I think of what's missing, there's some real gap in the plumbing, the infrastructure, the boring stuff underneath the transactions, that as carbon offsets and carbon removals and net zero becomes an increasingly important part of the economy, just need to be fixed. And I don't know whether, because it's so boring, I don't know whether it will get fixed. It's not sexy, but like there's real challenges to lock down land for nature-based solutions, for example. There are ways around this, but a lot of land law in Canada is designed to keep land in the market. And so mechanisms, it's actually quite challenging to lock down the use of land over the timescales that we're talking about for nature-based solutions. That's something that I see as a gap in the legal infrastructure around removals, for example. The other one that's very much people are not talking about, but is extremely challenging from a transactional perspective, is very hard to take security in carbon offsets, given the way carbon offset systems are set up. And so there's a number of ways, again, there are a number of ways around that if you've got a project that needs developing, but we've got a whole sector of the economy that's going to be increasingly important over the next 30 years. And we don't always have the legal tools in our toolkit that we would have for backstopping a transaction a normal transaction in the mining sector. And I think I don't know whether people are actively working on that. I certainly haven't heard of it. And it's something that would be very helpful for lawyers like us to be able to get deals done.
Lisa, Emilie, any comments?
Yeah, I'm happy to jump in. I think two areas where we've yet to see developments, but expect to probably see some are as a function of the impacts of climate change. And the first is we've seen it recently, particularly over the last year, where the climate impacts and adaptation are coming squarely and hitting our food supply. So I expect to see something in and around the associated agricultural sector and the sustainable food supply. And we've seen some corporates get ahead of that. Maple Leaf Foods was well ahead, a number of others definitely pushing forward with sustainable protein initiatives. So that's one area where I think we're going to see something that necessitates more legal development. And then the second area is in relation to uniquely Canadian and South American context, climate finance writ large as a tool for Indigenous reconciliation. And we've seen a couple projects of the Canada Infrastructure Bank look to that, specifically the Oneida Energy Storage Project and a few other elements really look to use potentially climate finance as a tool, one of many that are needed for Indigenous reconciliation. So those are two things I would identify, Tanneke. Over to Emilie.
Thanks, Lisa. I think I would just add to what Kai said in terms of the lack of a legal framework around a lot of what we think is going to occur in the near future in order to meet those net zero commitments by 2050. So if you take, for example, the carbon sequestration, there is a lack of a legal framework. If you're looking for what authorizations you need in order to set up this project, and if you have a project in Alberta versus in the US versus in Quebec, I mean, it will vary greatly from one jurisdiction to the other. And in many cases, there will not be a framework, and there will not be someone within government who's actually ready to receive an application for that type of project. So I think there's a big gap in terms of where the framework and the government machine is in terms of supporting especially the mining sectors, but also other sectors in this transition and in this achievement of those goals.
Super, thanks, Emilie, and Kai and Lisa as well. I certainly expect that if we were to have this seminar, this webinar, even 2 years down the road, but say 5 years, 10 years, the legal toolkit will have expanded significantly. And Emilie, to pick up on your point, I expect government capacity will also develop greatly in the various areas to enable further progress here. And in fact, it's probably necessary to enable further progress and to enable governments to meet their commitments. So it's going to be, I think, a very interesting journey for all market players, whether it's the resource company, whether it's the NGOs, whether it's the regulators, whether it's the government, civil society. I think we all play a role, to pick up on Lisa's earlier point as well. I would like to take this opportunity to thank each of you for the insights and for participating today. I'd like to also thank everybody who has joined us today in this, I think, very fascinating webinar and area. And I expect we will all be watching COP26 with interest and what comes out of Glasgow. And to pick up on one of Kai's earlier comments, of the four of us, Lisa will have the benefit of being on the ground, and Resilient will be offering a COP26 reporting service that is available, that provides daily email reports on developments issued on a day-to-day basis from on the ground. So feel free to contact Lisa if you're interested in that service. I think we will all be, as Kai said earlier, continuing to learn in this space, continuing to grow in this space, and continuing to ask questions. So I thank everybody again, thank our presenters, thank you for attending. And please tune in next week for the next mining webinar series, which will be on hydrogen, another very current and fascinating topic. Thank you again, and goodbye.
Thank you.